Please like, share, and subscribe. Wishing you happiness and good luck every day.
You know, we're always told that investing is some complicated game of picking the right stocks or perfectly timing the market. But what if the most important piece of the puzzle isn't the market at all, but you? Today, we're going to dive into a really powerful idea from the Quick Start Guide to Investing, the concept that your financial success actually starts with your own personal journey.
I love this quote from the author, Glen, because it just cuts right through the noise. The technical stuff, buying a stock or an ETF on your phone, that's the easy part. Literally anyone can do it in a few minutes. The real challenge, the hard part, is the mental game. It's building a foundation strong enough that you don't panic and sell everything the second the market gets a little shaky. It all comes down to your behavior.
So before we even start talking about portfolios or returns, we've got to start with the most basic question of all, the absolute bedrock of your financial life. What is your why? Think about it. You wouldn't just hop in a car and start driving without a destination in mind, right? Well, the exact same thing applies to your money.
And I want you to seriously take a moment and think about this for yourself. Why are you even watching this? Why are you interested in investing in the first place? That answer, whatever it is, that's your anchor. That's the thing that's going to keep you steady when the inevitable storms hit the market.
Do any of these hit home for you? Maybe you want to completely change your family's financial story for generations to come. Or maybe you just want more choices, more freedom in life. But I want you to look really closely at that first one. Get rich fast. That is a trap. It's a goal that comes from a place of consumerism, and it almost always leads people to make terrible decisions. The rest of these, though, those are powerful, sustainable reasons to build wealth.
And this brings us to a super important distinction, one that could literally define your entire financial future: the massive difference between acting rich and actually becoming wealthy. Believe me, they are two completely different things.
Let's break it down. Over here on the left, you've got rich thinking. This is all about having a high income, but spending it on things that go down in value, like fancy cars. It's about keeping up appearances and wanting that instant gratification. Now look at the right side, wealthy thinking. This isn't about income, it's about building your net worth. It's about buying assets that grow in value and being willing to delay gratification now for a much bigger payoff later. It's the difference between a mindset of consuming and a mindset of creating.
And if you need proof, just think about this. It's a wild statistic. A staggering 70% of lottery winners go completely bankrupt. Why? How is that even possible? Well, they were handed a ton of money, but they had a rich mindset, not a wealthy one. They didn't have the habits or the plan to manage it, so they just acted rich, and it made them broke again.
So you see, money itself isn't good or bad. It's just neutral. It's a tool, like a hammer. In the right hands, that hammer can build a beautiful house. But in the wrong hands, without a plan or the right mindset, that same hammer can cause a whole lot of damage. The real power isn't in the tool, it's in the person holding it.
Okay, now let's get to my favorite metaphor from the book. It's this idea of building your financial house. See, to create wealth that actually lasts, you have to build it from the ground up, starting with a rock-solid foundation.
And here's the big twist, the thing that so many people get wrong. Investing isn't the foundation. It's not even the walls. Investing is the roof. It is the absolute last thing you put on top of an already strong and stable structure.
Here's what that blueprint looks like. The foundation, the very bottom layer, is having a solid spending plan, being totally consumer debt-free, having cash reserves, and having protections in place like insurance and a will. Then, the walls that hold everything up, that's your career and your retirement savings. And only when all of that is secure do you finally add the roof, your investment portfolio.
Because what happens if you try to build a roof on a pile of sand? It's going to collapse at the first sign of a storm. It's the same with your money. If you don't have an emergency fund or a good spending plan, you'll be forced to sell your investments, probably at a huge loss, just to cover a surprise car repair or medical bill. And just like that, your long-term plan becomes a short-term disaster.
Okay, so how do we start laying that foundation the right way? Well, it all begins with adopting what the author calls a contrarian mindset. That means challenging all the common financial wisdom out there that can actually end up weakening your financial house. Let's look at a couple of quick examples.
We hear this one all the time, don't we? Oh, I just put everything on my credit card for the points. It sounds so smart, like you're hacking the system and getting free stuff. But is it really a win?
Well, the contrarian view says that for most of us, it's actually a trap. Credit cards are psychologically designed to make us spend more money than we would with cash. That tiny little reward you get from the points, it gets completely wiped out by the extra money you end up spending. Your behavior will always beat the hack.
Okay, here's another big one. The advice is always, start investing now. The earlier the better. Compound interest is magic. And you know what? It is magic. But the common advice to just throw every single spare dollar you have into the market right from day one, that might not be the best move.
The smarter, truly contrarian move? Invest in yourself first. Your ability to earn an income is your single greatest wealth-building tool, especially when you're just starting out. The financial return you'll get from advancing your career and boosting your salary will almost always blow away the returns on a small, early investment portfolio. Build your income engine first, then you'll have real fuel for the fire.
When you boil it all down, it comes back to this incredibly simple 3-point philosophy for your money. Number 1, live on less than you earn. That's the foundation. Number 2, be generous. This builds a mindset of abundance, not scarcity. And number 3, invest the rest. See, it's not a complicated budget. It's a life plan that puts everything in its proper, powerful order.
So ultimately, we end up right back where we started. Money is just a tool. It has no power on its own. The real question isn't just, how do I get more of it, but how will I choose to use it? Now that you have the blueprint for a sound financial house, the question for you is, what are you going to build?
Hey, welcome back. So you're thinking about investing, right? Stocks, crypto, it's everywhere. But hold on a second. What if I told you the single most important move you can make has absolutely nothing to do with what you buy? Let's get into it. It is so easy to get swept up in all the hype, right? You see it on your phone, you download an app, but have you actually stopped for a second and asked yourself what's really, really driving you to do this? Because that one question, well, it's the foundation for literally everything that follows. And that right there brings us to the first big idea we need to tackle, figuring out your investing why. Look, this isn't just about making a pile of cash. It's about knowing what that cash is for. We've got to get super clear on your motivation. No, seriously. Pause for a second if you need to. Why do you really want to do this? The first answer that pops into your head might not be the whole story. Let's peel back the layers and look at a few of the most common reasons people start. Okay, let's be honest. For a lot of us, it's this. The big dream, right? Get rich and get rich fast. It's not even really about the money itself, is it? It's about what the money represents, an escape hatch from your current situation. Or maybe it's just this. Quitting your job. You feel stuck in that classic 9-to-5 grind, like you're running on a hamster wheel that's not going anywhere. And investing? It feels like the only lever you can pull to get off and finally own your own time. And then there's this one, which goes a lot deeper. Maybe you're doing this to completely change your family's future. You want to give your kids opportunities you just never had. You want to break a cycle and start a new financial legacy. Now that is a why with some serious weight to it. Look, all these reasons are totally understandable, but that first one, the get rich fast dream, that one is a dangerous trap. Why? Because it's usually not about building something lasting. It's about a desire to spend more. And if that's the foundation you're building on, well, it's a recipe for disaster. And that leads us right into a really, really important distinction we have to make. The goal shouldn't be to look rich. The goal is to actually be wealthy. And trust me, those are two completely different things. Just let this sink in for a second. Acting rich will make you broke. It's so simple, but it is so true. All that stuff you see flashing around on social media, the fancy cars, the expensive watches, that's not wealth. That's just a receipt. It's evidence of spending. You need proof? Okay, how about this number? 70%. What is that? Well, according to the National Endowment for Financial Education, that is the percentage of lottery winners who go completely bankrupt within just 5 years. 70%. Think about that. They get a mountain of cash, they immediately start acting rich, and poof, it's all gone. Okay, so let's really break this down. What is the actual difference between being rich and being wealthy? It all comes down to two totally opposite mindsets. Let's start with what it looks like to just act rich. All right, so the rich mindset, it's all about right now. You might have a high income, sure, but where does it go? It goes to stuff that loses value the second you buy it. We call those depreciating assets. Think new cars, designer clothes. It's all about keeping up appearances, right? That instant hit of gratification. In this model, you are always, always working for your money. Now, let's flip that coin. The wealthy mindset is a totally different ballgame. It's not about how much you make, it's about your net worth, which you own minus what you owe. It's about spending your money on things that actually grow in value over time, appreciating assets, like investments. This takes serious discipline and that delayed gratification we talked about. And here's the kicker. You're not working for money anymore. You're making your money work for you. Okay, so if the goal isn't just to get rich and buy a bunch of stuff, then we have to completely change how we think about money. We have to reframe our relationship with it. It's not the prize at the end of the race. So what is it then? Well, think of money like a hammer. A builder can take that hammer and build a beautiful house, right? But that exact same hammer can be used to tear it all down. The hammer itself isn't good or bad. It's a neutral tool. It's all about who's swinging it. Here's the truth. Money is a magnifier. It doesn't magically change your character. It just turns up the volume on who you already are. If you're a kind, generous person, more money will just make you more generous. If you're kind of a jerk, well, you're going to be a much bigger jerk. You get the picture. All right, so we've shifted our mindset. We see money as a tool. So what now? How do we actually put this into practice? Well, it can actually be boiled down to a super simple 3-point plan for how you handle your money. Seriously, this is it. This is the whole game plan. Number 1, live on less than you earn. You have to create a gap, a surplus. That's non-negotiable. Number 2, give generously. This might sound counterintuitive, but it builds character, it gives you perspective, and it keeps you from becoming obsessed with hoarding money. And then, finally, number 3, you invest the rest. That surplus you created in step 1, that's what you use to build wealth. Okay, now let's pull all of these ideas together with a really powerful metaphor that I think makes this crystal clear. Stop thinking of your financial life as some kind of get-rich-quick race. Instead, think of it as a construction project. You are building a house from the ground up. And here is the absolute key to this whole thing: investing. That's the roof of your financial house. And what's the last thing you put on a house? The roof. Why? Because imagine trying to build a roof on shaky walls and a crumbling foundation. The first storm that comes along, a job loss, a medical emergency, you're going to have to sell your investments. You're going to have to tear down your roof just to patch the holes in the foundation. So here it is. This is the blueprint that ties everything we've talked about together. It's called the Sound Financial House. And just look at it. The most important thing to notice is that it's built in layers, starting from the very bottom and working its way up. Let's take a quick look at what that means. So you can see how it's built. You start with the foundation. That's your spending plan. It's getting totally debt-free. It's protecting your family with things like insurance and a will. Then, once that foundation is solid rock, you build the structure, the walls. That's your career, your bigger lifestyle goals like buying a home or starting a family. And only then, only when all of that is secure, do you put on the roof. That's your investing. Your stock portfolio, your property investments, it goes on last. And really, this brings us back to the ultimate goal of all of this. It's not about chasing a pile of money so you can escape a life you can't stand. It's the opposite. It's about using these principles to intentionally design a life that you actually love, and then using money as the tool to make that life possible. So I'm going to leave you with this one last question to think about. Take a hard look at your habits, your mindset, and especially your why. Are you just acting rich? Or are you actually building wealth? Because how you answer that question, that's what's going to define your entire financial future. So let's talk about money, but probably not in the way you're used to. See, this isn't about chasing hot stock tips or some kind of get-rich-quick fantasy. Nope, this is about a deep, fundamental shift in your mindset, one that can help you build a genuinely strong financial future. And it all kicks off with this really powerful riddle about the one thing that truly controls our success. The author of our source material starts with this riddle, and you gotta hear this. It goes, "Show me exactly how you want something done, and after a few lessons, I will do it automatically. I am the servant of all great people, and alas, of all failures as well. Take me, train me, be firm with me, and I will place the world at your feet. Be easy with me, and I will destroy you." So, who am I? Well, the answer is your habits. And when we're talking about your financial life, your habits around money are, well, they're everything. They can be your absolute greatest helper, or they can be your heaviest burden. And the choice, when you really get down to it, is yours. Okay, so if habits are the key, the very first one we have to get a handle on is our spending. Because let's be honest, for so many of us, the reason we struggle with money is that our financial lives start out in a state of, well, total chaos. Sound familiar? I mean, the author is super honest about it, admitting that for years he was a financial train wreck. And it's no wonder, right? Most of us are just kind of thrown into the deep end of adulthood with zero instructions on how to handle our money. It can feel like you're playing a game you're destined to lose right from the start. And I just love the honesty here. The point is not about magically developing perfect willpower overnight. It's about being self-aware. It's about knowing your own nature, your impulses, your weak spots, and then being smart enough to build a system that protects you from yourself. The system is the fix, not trying to become a totally different person. And this visual really gets to the heart of it. You just can't have both. You can't build this incredible skyscraper on a foundation of sand. It's just not going to work. You have to make an active choice to build a strong financial future. And that choice always starts with creating a solid system for your money. So, how do you actually start to take control? Well, it begins by finding a structured system that actually fits your natural behavior. And our author lays out two main paths you can go down. This is basically the fork in the road. Are you the kind of person who needs to figure out what it costs to live first and then invest whatever's left? That's the bottom-up way. Or do you invest a set amount right off the top and then force yourself to live on the rest? That's the top-down approach. Now, for most of us, especially if you're just getting started or you feel like your finances are a total mess, the advice is to begin with the bottom-up approach. Why? Because it's not about shocking your entire system into submission. It's about building habits that actually stick and getting those small early wins that keep you going. And you can see how the process just builds on itself. You don't jump straight into investing a ton of money. First, you just get a system working and you let it run for a bit. Then you start small with investing, just enough to get engaged and learn the ropes. As you get more control and really look at your spending, you can start to ramp it up. It's a realistic, step-by-step path. So what about that top-down method? Well, it tends to work for a pretty specific type of person. Someone who's already super frugal or has been saving like a machine their whole life. It can be, and I'm quoting the author here, very militant. It definitely gets results, but you have to be really careful you don't forget to actually enjoy your life today. Okay, so you've got your spending system dialed in. Now it's time to invest. But this is where we get a really powerful mindset shift about what the goal of investing really is. Just let that sink in for a second. The goal is not to make money in that stressful, active, day trading sense of the phrase. It is so much simpler. It's about finding a safe, diversified place to park the cash you don't need right now and just letting it grow quietly over time, beating inflation. Thinking about it this way just takes all the pressure off. And that leads us to the absolute core idea of this entire explainer. Your number one wealth-generating tool, especially when you're just starting out, is not the stock market. It's your ability to earn an income, your job, your business. That is where your real power is. All right, let's make this real with an example. Let's meet Mia. She's doing great. She's got a good salary, and she's already got 20 grand invested. But here's the million-dollar question. Where should she focus her limited time and energy to get the biggest bang for her buck financially? So this table shows what a pretty good year might look like for Mia's portfolio. If she takes a smart medium risk approach, like with an ETF, which is just a big basket of stocks, she might make $1,600. Not bad at all. Now, if she gets insanely lucky with some risky startup, maybe she makes $10,000. But that is a huge, huge gamble. So let's focus on that realistic medium risk number, a $1,600 return. That's what her $20,000 earned for her in the market. But now, what if instead of spending all those hours trying to outsmart the market, she put that same energy into her career? The argument here is that getting a $10,000 raise is often way easier and a lot less risky than trying to squeeze that same amount of money out of a small portfolio. And you know what? That raise shows up year after year after year. And this brings us to the single most powerful and honestly empowering lesson in this whole discussion. It's all about where you put your focus. When your portfolio is on the smaller side, the single biggest thing that impacts its growth isn't the market's return. It's your savings rate. It's the new money you add from your paycheck. That's the one thing you have 100% control over. I mean, just look at these numbers. This is amazing. If you have a $20,000 portfolio and you just manage to add $100 a week, that's a return of 26% from your own capital. Think about that for a second. You would have to take some crazy risks to get a 26% return from the market. Your ability to save, that is your superpower. And this is the punchline. This reframes the entire game. Stop chasing massive, risky gains and start focusing on systematically, consistently adding to your investments. That is how you really win, especially in the early stages. And that's really it, isn't it? Building real wealth isn't supposed to be some kind of adrenaline rush. It's the result of a solid, consistent, and a boring system. The excitement shouldn't be coming from your investment app. It should be coming from, your actual life. And that's the final thought I want to leave you with. If you can get your money system automated and just let your investments do their quiet thing in the background, it frees up your most precious resources, your time, your focus, your energy. So the real question isn't just how you're going to manage your money, it's what amazing things you're going to build with the life it gives you.
So, you ready to start investing? Awesome. It's super tempting to jump right in and start looking for the perfect app, right? The one that looks the coolest or has the absolute lowest fees. But here's the thing. That's actually not where you should be starting at all. In fact, it's pretty much the last thing you should be worrying about.
So what is the biggest mistake I see new investors make time and time again? It really gets to the core of why so many people feel overwhelmed and honestly end up making some bad calls right out of the gate. Well, financial expert Glen James totally nails it. He calls it majoring on the minor. And what does that mean? It means people get completely hung up on the small stuff, the surface-level details, the app, the broker, the fees, instead of focusing on what's actually going to make them successful.
Seriously, this mistake is so common, we gotta break it down. It's all about getting your priorities completely backwards from day one. And when you do that, you're kind of setting yourself up to fail before you've even put a single dollar into the market.
Okay, let me put it this way. Focusing on an app's cool design is like picking a car just because you like the color. I mean, think about it. You're totally ignoring the most important question. What do you actually need this car for? Do you need a big SUV for the family or a zippy little two-seater for yourself? The whole point is function has to come way before form.
And this is where the rubber meets the road, right? This shows you the real-world consequences. If you're hopping into an online forum freaking out and asking, hey, my portfolio's down, should I sell? Well, that's a giant red flag. It means you're driving without a map. You have no strategy to fall back on, and that just leads to panic selling the second things get a little rocky.
So, how do we fix this? It's actually way simpler than you might think. We just flip the whole process on its head. We're going to build the foundation, your strategy, first, before we even glance at an app or a tool. Ready? Let's dive in.
Your entire strategy is built on just 3 simple pillars. Super easy to remember. First, we figure out your risk and your timeline. Second, we choose how you'll own your investments. And only then, as the very last step, do we pick a product. Let's break each one down. Okay, let's kick things off with pillar number 1, risk and time. Think of this as the absolute foundation of your entire plan. It's all about figuring out what you're building with, and maybe even more importantly, how much time you've got to build it. When you boil it all down, investing really just comes down to 2 types of assets. On one hand, you've got your defensive assets. Think cash, bonds, stuff that's all about stability. It's predictable, but the growth is, well, it's lower. Then you have growth assets, like stocks or property. These are going to be more volatile for sure, but they have way higher potential for growth over the long haul. And check this out. This visual really shows you the magic of time. See that top line for growth assets? Look how bumpy and all over the place it is in the short term. That's volatility, right there. But look what happens over the long run. It climbs so much higher than that steady defensive line. Time is the secret sauce that smooths out all those bumps and lets the growth happen. So here's the key takeaway. You have to match the right asset to your timeline. If you need your money in, say, less than 5 years, maybe for a down payment on a house, you just can't afford that kind of volatility. You need defensive assets to keep that capital safe. But for long-term goals like retirement, stuff that's more than 5 years out, well, you've got time on your side to ride out those waves and let your growth assets really work their magic. All right, on to pillar number 2, ownership. Now, this is a step that, honestly, most beginners just blow right past. But it is so important. It's not just about what you own, it's about how you legally own it. And trust me, this can have massive consequences for you down the road.
So as you can see, there's a whole spectrum of ways to own your investments. They range from really simple and cheap to pretty complex and pricey. And the one you pick has huge implications for things like your taxes or even what happens to your investments if you pass away. It really just depends on where you are in life and what you're trying to achieve.
You know, when we talk about ownership, we're really just trying to answer 3 basic questions. Number 1, whose name is on this thing? 2, how are we going to get taxed on any income or profits? And 3, a really important one, what happens to this investment if I'm not around anymore? Whatever structure you choose has to have a clear answer for all 3 of those.
And these 2 examples show you perfectly why there's no one-size-fits-all answer. Take Jesse. He's young, single, future's wide open. For him, just investing in his own name is perfect. It's simple, cheap, and super flexible. But then you have Oliver. He's in his 40s, has a family, owns a business. A family trust just makes way more sense for him. It protects his assets from his business and gives him much better tax options.
Okay, so you've figured out your risk, you know your timeline, and you've sorted out your ownership structure. Now, and only now, are you finally ready to go pick an app or a broker. See, it's the last piece of the puzzle, not the first. Now, once you get to this point, you are absolutely going to run into this big, heated online debate, chess versus custodian. It's all about how your shares are legally held. Are they directly in your name, or is a third party holding them for you? People get really passionate about this. But honestly, for most new investors, it's just another perfect example of majoring on the minor. I love this quote from the source material. It just says it all. What you buy is about 1 million times more important than how you buy it. That's it, right there. The actual investment you choose and the strategy behind it, that's what really matters, not the technical plumbing of how it's all held together.
And hey, here's a little fact that might surprise you. Your superannuation, which for a lot of people is their biggest investment by far, is almost certainly held in a custodian model. It's a totally standard, secure, highly regulated way of holding assets. The entire financial industry uses it. So let's circle all the way back to that car analogy we started with. You would never just wake up and decide to buy a car based only on its paint job, right? Of course not. You'd think about whether you need a big family SUV or a little city runabout first.
So the real question is, why on earth would you treat something as important as your financial future with any less thought? Why would you pick an investment based on something as minor as how pretty the app looks?
So now you've got the framework. You know how to build a solid strategy first. The product, the app, that's just the tool you pick up at the very end. So the real question now is, what are you going to build?
Have you ever felt like the world of investing is some kind of secret club you weren't invited to? Well, hey, consider this your official invitation. We're about to go on a little quest to demystify the whole thing, one simple step at a time. So, let's start our quest with a pretty important question. Is the money you've worked so hard to save actually losing its power while it's just sitting there? The answer, and I hate to be the one to tell you this, is yeah, it is. And that's exactly why we're talking about this today. All right, here's our game plan. First, we're going to face our main villain, inflation. Then, we'll uncover the magic of compounding, get you your financial tools, which are the different types of shares, and then we'll learn how to read the map of market cycles. And finally, we'll get you the ultimate piece of gear, the shield of diversification. Okay, every good story needs a villain, right? And in our financial adventure, that villain has a name, inflation. It's kind of like this silent thief that's always trying to sneak away with the value of your money. Just think about it, you know? That cup of coffee that maybe cost you $1 a few years back? Yeah, not anymore. That's inflation in action. On average, it chips away at your money by about 3% every single year. That means just to break even, your money has to grow by more than 3%. So, what do? Well, you could go the super safe route with government bonds, but they're not really built to beat inflation. Your money will be there for sure, but its buying power, that's going to shrink. Now, shares, on the other hand, they have a long history of growing faster than inflation. And that's what we call real growth, when your wealth actually increases.
Now that we've met our enemy, it is time to reveal our secret weapon. This is the superpower that every single investor has. And honestly, it's one of the most powerful forces in the entire financial universe. It's called compounding.
This idea is so powerful, some people call it the 8th wonder of the world. And there's this great quote, often linked to Einstein, that says, "He who understands it earns it, he who doesn't pays it." So what is this magic force that can literally make or break your financial future? Let me just ask you something. If I offered you a choice,
$1 million, cash, right now, or a single penny that magically doubles in value every day for 30 days. Which one are you taking? Go on, think about it for a second.
If you chose the penny, wow, congratulations. After just 30 days, that one little penny would have mushroomed into over $10.7 million. That right there is the absolutely mind-blowing power of compounding.
This chart shows it all perfectly. It's the two roads your money can take. That bottom line, that's your money in a leaky bucket, just slowly losing value to inflation. But that top line, that's a snowball rolling downhill. It just gets bigger and bigger and bigger, faster and faster. That's exponential growth. That is the magic of compounding.
So what's the secret sauce that makes compounding work its magic? It's really simple. It's time. The earlier you start, the less you have to put in. I mean, just look at these numbers. To get to $1 million for retirement, a 20-year-old only has to put away about $178 a month. But if you wait until you're 50, that number skyrockets to almost $5,000 a month. Time, my friends, is your most valuable asset.
All right, so you've met the villain, you've discovered the magic. Now it's time to gear up with the right tools for this quest. So let's do a quick run-through of the 6 basic types of shares you're going to come across.
Okay, first, you've got growth shares. Think of these as the sprinters. Then, cyclical shares, which kind of ride the waves of the economy. Blue chips are your big, steady, reliable giants. Speculative shares, they're the high-risk, high-reward wildcards. Defensive shares are the things people buy no matter what's going on. And finally, you've got dividend shares, which actually pay you cash just for owning them.
So having the right tools is great, but knowing when and where to use them, that's a whole different ballgame. And that's where our map comes in. For an investor, the map is the economic cycle. Understanding it, that's absolutely crucial for making smart moves.
This gives us a great bird's-eye view of the whole journey. See, the economy doesn't just go in a straight line. It ebbs and it flows. It moves through these periods of growth, which we call expansion, and periods of decline, which we call contraction. And different investments do better in different parts of this cycle.
So let's follow the trail, okay? In stage 1, when the economy's cooling off, bonds are your best bet. Then in stage 2, as things start looking up, shares start to get in on the action. By stage 3, hey, it's a party for everyone. Shares, bonds, commodities, they're all doing great. In stage 4, the party is in full swing for shares and commodities. Stage 5, that's the peak, when commodities get their moment to shine. And then stage 6, that's the cool down, before the whole thing starts all over again.
Okay, we have our mission, we have our magic, we've got our tools, we've got our map. But no hero should ever set out on an adventure without a shield. And in the world of investing, your absolute best defense is something called diversification.
You know, I absolutely love this analogy. Building a strong portfolio is a lot like putting together a great meal. You wouldn't just sit down to a giant steak and nothing else, would you? Of course not. You want the potatoes, the salad, the vegetables. Diversification is about creating that kind of balanced meal for your money.
Let's look at a real-world story. This is Courtney. She worked at Macy's and had a good chunk of her savings invested right back into the company. Now, what's the problem? Well, her entire portfolio was 100% Macy's stock. That is like having nothing but steak for every meal of your life. It's a recipe for disaster.
So, realizing how risky this was, Courtney made a super smart move. She sold most of her Macy's stock and used that money to buy shares in totally different industries. We're talking energy, tech, even fast food. Now, if one part of her portfolio takes a hit, the others can help soften the blow. She literally built herself a financial shield.
So, there you have it. We've covered the basics for our financial quest. You now have the map, you've got the tools, and you've got the shield. The only question left is, what's the first step of your adventure going to be?
Have you ever felt that starting to invest is like standing at the bottom of a giant, confusing mountain? Well, if that's you, then you're in the right place. We're about to cut right through all that noise and find a simple, really powerful starting point that can help you get over that investment paralysis for good. You know, for so many of us, the idea of putting our hard-earned money into the market is, well, it's just intimidating, right? It can feel like this high-stakes game where you don't even know the rules. And that fear of making one wrong move can be completely paralyzing. And these aren't just some vague worries. They're really specific fears. First, there's that nightmare of picking a total dud. You buy a stock and poof, it just tanks. Then you've got the opposite problem, FOMO, the fear of missing out. You hear about your neighbor's investment going up like 5,000% and you're just sitting there. And finally, the big one, analysis paralysis. I mean, how can you possibly pick the right company out of literally thousands of choices? And it's worth remembering, it used to be even harder. In the not-so-distant past, investing meant dealing with brokers whose main goal, let's be honest, wasn't always your profit. It was their commission. That old, complicated system made it so tough for the average person to get a fair start. But thankfully, the game has totally changed. So, how do we conquer those fears and just sidestep all that old-school complexity? Well, the answer lies in a single, incredibly powerful tool. It's time to meet the hero of our story. Say hello to the index fund. Look, instead of trying to find that one winning needle in a giant haystack, an index fund basically lets you buy the entire haystack. With just one single purchase, you own a tiny piece of hundreds, sometimes thousands of different companies. Its job isn't to beat the market, it's to be the market. And that, as we'll see, is its superpower. A great way to picture this is what's called the core and satellite approach. Think of your index fund as the core. It's the big, stable planet at the center of your financial universe. It should make up the vast majority of your portfolio, like 80 or 90%. It's your foundation. All those smaller, riskier satellite investments, they can come later if you even want them. For most of us, that core is all you'll ever need. Okay, so the concept is simple, but how does it actually perform out there in the real world? Well, this is where indexing goes from a nice idea to an absolute game changer. What you're looking at here is a fantastic way to visualize diversification. This is a heat map of the S&P 500, which is just an index of 500 of the biggest companies in the US. When you buy an S&P 500 index fund, you're buying a piece of all of this. The giant squares like Microsoft and Apple, yeah, but all the smaller ones too. So if a few companies have a rough year, who cares? It doesn't sink your portfolio because hundreds of others are probably doing just fine. And hey, if you won't take my word for it, how about the word of arguably the greatest investor of all time? Warren Buffett himself has said over and over that for most people, the best thing you can do is just buy a low-cost S&P 500 index fund. When the Oracle of Omaha speaks, it really pays to listen. And this chart really just spells out why. Take a look at the long-term track record here. Sure, there are down periods. Look at the 2000s. That was rough. But over the decades, the trend is powerfully upward. Investing in an index is really just a bet on the long-term growth of the overall economy, which, historically, has been a very, very good bet to make. This brings us to the classic investing showdown. On one side, you have the slow and steady index fund. On the other, you have the actively managed fund, where some manager is frantically trying to beat the market by picking stocks. But all that frantic activity comes at a cost, and it comes in the form of much, much higher fees. And those fees eat directly into your returns, year after year after year. So, here's the billion-dollar question. Are those high fees worth it? Well, the data says, overwhelmingly, no. A whopping 75% of these expensive, actively managed funds actually failed to do the one thing they're paid to do: beat the simple, low-cost index. You are very often paying more for worse performance. Just let that sink in. Okay, so we've nailed the what and the why. Now it's time for the fun part, the how. Let's look at a few simple, actionable blueprints you can use to build your very first portfolio using these exact principles. For decades, this was the gold standard, the 60-40 portfolio. 60% in things that grow, like stocks, and 40% in more stable things, like bonds. It was always considered the safe, balanced approach. But, well, safe might not mean what you think it means. Because during the 2008 financial crisis, this supposedly safe portfolio lost over 20% of its value. Now, the bonds did help cushion the blow, but a 20% loss is hardly what most people would call safe, right? It just goes to show that even traditional wisdom needs a reality check now and then. So what's a more modern, more robust alternative? Enter the beautifully simple 3-fund portfolio. The idea is so elegant. You own the entire stock market of your home country, you own the entire stock market of the rest of the world, and you own the entire bond market. That's it. You get maximum diversification with minimal complexity. And this is kind of what it could look like in practice. If you're a younger investor with a long time to go, you might have a higher chunk in stocks for growth, say 70% domestic, 20% international, with just a small 10% slice in bonds for stability. It's simple, it's globally diversified, and it's incredibly low cost. But wait, what if picking 3 separate funds still feels like too much work? Well, believe it or not, it gets even simpler. You can buy a single, all-in-one, diversified fund. This example from Vanguard shows how, with one click, you get a pre-packaged portfolio that's already spread across Australian stocks, international stocks, bonds, the whole shebang. It even rebalances itself automatically, which means you never have to lift a finger to keep it on track. And for the absolute ultimate set-it-and-forget-it option, you have target date funds. It's so easy. You just pick the fund with the year that's closest to when you think you'll retire. The fund does literally all the work. It starts out aggressive when you're young, then it automatically, gradually gets more conservative as you get closer to retirement. It is truly investing on autopilot. Wow. Okay, so we've gone from the fears that hold us all back to a whole series of increasingly simple, powerful solutions. Now, for this last part, it's all about you. So take a second and really think about it. Are you a stock picker? Do you own a bunch of those expensive active funds we talked about? Or maybe you haven't even started at all. Based on what we've just covered, it's time to take stock of where you are right now. And this, right here, this is the most important question. What kind of investor do you want to be? Do you want to be a 3-fund investor? A one-stop shop investor? See, the goal isn't just to learn this stuff. It's to actually use it to choose a path that fits you and lets you build your wealth with confidence, not with fear. So, what's your next move going to be?
So, you've gotten the hang of index funds, you're comfortable with the basics, and you're probably asking yourself, what's next? Well, if you're ready to go from passively owning the whole market to actively trying to pick the winners within it, then you are in exactly the right place. Let's get into it.
Let's kick things off with a classic from the Oracle of Omaha himself, Warren Buffett. He says, diversification is for people who don't know how to analyze a business. I mean, that's pretty direct, isn't it? But it raises a fantastic question. What if you could learn how to analyze a business? What if that's the key? So, picture this. Investing in individual companies is like deciding to climb a massive mountain. And you know what any experienced mountaineer will tell you? The climb itself isn't the hardest part. Nope. The real work is the hundreds of hours of preparation, the research, the planning, everything you do before you even set foot on the trail.
And this is where it gets really interesting. For most of us, Buffett's advice is super simple. Just buy an S&P 500 index fund and call it a day. But that's not what he does, is it? He and his team at Berkshire Hathaway, they spend their entire lives digging deep, researching, and picking individual companies. The point is, he's showing you there's another level to this game if you're willing to play.
Which naturally leads to the big question, right? Is beating the market even possible? You've probably heard it's like winning the lottery, that it's a fool's game. Well, let's put the chatter aside and actually look at the data.
Okay, check this out. These are the top performers in the S&P 500 from 2023. I mean, just look at those returns. Absolutely staggering. But here's the real kicker. Remember all that buzz about the magnificent 7 stocks driving the entire market? Well, take a closer look at this list. Only 3 of them, Nvidia, Meta, and Tesla, actually cracked the top 10. There were plenty of other huge winners out there.
And that brings us to the most important number of all. In 2023, 200 of the 500 stocks in the S&P 500 either met or beat the index's average return. So let's break that down. It means if you'd picked a stock completely at random, you had a 40% chance of doing just as well as, or even better than the market. That's not a lottery ticket, folks. That's a pretty good shot if you know where to aim.
Okay, so if it's possible, how do we tilt the odds in our favor? Well, that's where doing your homework comes in. And this is about understanding the story behind the stock ticker. Let's see what that really means.
You know, the legendary investor Peter Lynch absolutely nailed it. People will spend weeks researching the best TV or car, reading every review, but then they'll throw their life savings into a stock they heard about from a stranger. The first rule is so simple. Don't invest in what you don't understand.
So what does it mean to understand a company? Start by asking these 4 simple questions. Can you explain in plain English what the company actually sells and who they sell it to? Is all their revenue tied to one single product, or are they a one-trick pony? And what happens if the economy takes a nosedive? Answering these will get you 90% of the way there.
And hey, let's not forget about the people steering the ship. Great leadership is critical. I mean, look at what happened with Disney in 2022. The day they announced they were bringing back CEO Bob Iger, the stock jumped over 6%. Just like that. Why? Because investors had confidence in his vision. So you've got to ask yourself, who is the CEO? Do they have a good track record? It really, really matters.
All right, so we've covered the story, the qualitative side of things. Now it's time to get our hands on the tools, the quantitative side. And don't worry, you don't need a math degree for this. These are just 6 essential ratios that help you take a company's financial temperature.
First up, we've got the price-to-sales ratio. This one is simple. It tells you how much you're paying for each dollar of a company's sales. As a general rule, a lower number means you're getting a better deal. It's a great starting point for finding value.
Next is the famous PE ratio. This tells you how much the market is willing to pay today for a dollar of a company's profits. Now, to give you some context, the historical average for the S&P 500 is around 21. So, a company with a PE of 15 might be considered undervalued, while one at 40 could be seen as pretty expensive.
Now, EPS, or earnings per share. This is the bottom line. It's the company's total profit divided by the number of shares. And this metric is crucial. As an investor, you want to see a company that is not just profitable, but one whose profits are consistently growing over time.
Return on invested capital might sound complicated, but the idea is simple. A company uses money, capital, to run its business. This ratio shows how good they are at generating a high return on that money. If a company can borrow money at 5% and generate a 15% return with it, well, that's an incredibly efficient and profitable business.
Oh, I love this one. Free cash flow is the actual cold hard cash a company has left over after paying all its bills and expenses. This ratio compares the stock price to that pile of cash. It tells you if a company is a cash-generating machine. Historically, a ratio under 10 is a sign of excellent value.
And last but not least, for those who like to get paid while they wait, there's the dividend yield. This is the cash payout you receive from the company, expressed as a percentage of the stock price. It's your money literally making you more money.
Okay, we've covered the qualitative story and the quantitative tools. Now, for the final section, putting it all together to find what are known as compounder stocks, the true long-term winners.
Here's another game-changing quote from Buffett, heavily influenced by his partner Charlie Munger. See, the old way of thinking was to find cheap stocks. The Munger way is to find great businesses. The focus shifts from the price tag to the quality of the company itself. And this chart really illustrates why. Look at this 25-year period. The gray line at the bottom shows the return from buying stocks when they're cheap, the PE ratio. It's almost flat. But the dark gray line rocketing upwards, that's the return driven by the company's actual earnings growth, its EPS. The crucial point is, over the long run, a company's performance, not its starting price, is what creates real wealth.
So how do you spot one of these compounders? Here's a powerful checklist of financial markers. First, return on capital over 20% means for every dollar they invest in their business, they're getting more than 20 cents back in profit. Gross margin over 55% shows they have strong pricing power. An operating profit margin over 20% tells you the core business is very profitable. Cash conversion over 85% means most of their profits are turning into actual cash. And finally, an interest cover over 10 shows they can easily pay the interest on their debts. These are the signs of companies that can compound their value year after year.
And that brings us right back to where we started. Picking individual stocks isn't about guesswork or hot tips. It's about preparation. You've now seen the tools and the philosophy used by the best in the world. You have the map, and you have a guide to the gear. The only question left is, are you ready for the climb?
Welcome to The Explainer. So today, we're going to talk about a way to invest, not just in companies, but in the future itself. It's a strategy called thematic investing. And you know what? It's all about spotting the massive, world-changing trends before everybody else does. Let's dive in. You've seen the headlines, right? Some company's stock suddenly goes to the moon because of an AI breakthrough, or a retailer that everyone thought was dead and buried suddenly becomes the hottest thing on Wall Street. Well, what if I told you these aren't just random blips on the radar? They're actually part of a much bigger story, a theme. Okay, so what exactly is thematic investing? Well, imagine for a second that you could just tune out all the daily noise of the stock market, and instead, you focus on the huge shifts happening all around us. You know, things like the rise of artificial intelligence or the global push for clean energy. That, right there, is the core idea. Now, here's the textbook definition for you. It's about finding these giant, long-term trends. Think massive shifts in technology, society, or the economy, and then pinpointing the specific companies that are perfectly positioned to ride that wave. But really, it all just boils down to this. You're investing in the big picture. You're not worried about next quarter's earnings report. You're making a bet on the massive stories you believe are going to shape our world for years, maybe even decades to come. All right, let's look at some recent themes in action, because honestly, the best way to wrap your head around this is to see how it's played out in the real world. So let's take a quick trip back in time, from 2020 to 2023, and see how major events created these incredible investment themes. I mean, just look at this timeline. It's pretty clear, right? Each of the last few years had its own dominant story. In 2020, the world shut down, and the stay-at-home economy was born. 2021 gave us that wild ride with meme stocks. Then, geopolitical events in 2022 put a huge spotlight on oil and gas. And of course, 2023 was, without a doubt, the year of the AI boom. Let's break them down one by one. Remember 2020? We were all stuck inside. So the theme was obvious. Any company that made our at-home lives better was set to win. And boy, did they. Take Peloton, the home exercise company. Its stock soared an absolutely mind-boggling 434% that year. Then came 2021, and a completely new force took center stage, the retail investor. Everyday people coordinating on social media, pouring money into what became known as meme stocks. And the undisputed king of the meme stocks? A video game retailer everyone had written off, GameStop. And the result? It was explosive. GameStop stock finished 2021 up a staggering 687%. It was a completely wild, unpredictable ride, and a perfect example of a theme driven entirely by social momentum. This chart really shows you the power of being in the right theme. Check this out. In 2022, the overall market was having a terrible year. The S&P 500 was down 18%, but a single geopolitical event sparked an energy crisis, and suddenly the oil and gas theme just surged. So while almost everything else was tanking, some energy stocks were up over 130%. And that brings us to 2023. The theme couldn't have been more obvious: artificial intelligence. It was so powerful that it almost didn't matter what your company did. If you made the chips like NVIDIA, ran a social network like Meta, or built chatbots like Google and Microsoft, if you had a convincing AI story, investors were all in. So we've seen the incredible potential, right? The returns can be huge. But beyond the hype, what's the real allure of themes? Why are so many investors drawn to this strategy? Well, there are a few really big draws. First, you're aligning your portfolio with these powerful global megatrends. You're literally investing in the direction you think the world is heading. It also lets you tap into genuine long-term growth by investing in real innovation and disruption. And finally, and this is a big one for a lot of people, it's a way to put your money where your values are, whether that's in clean energy or life-saving medical tech. But, and this is a huge but, it is not all sunshine and rainbows. The very same forces that create that explosive growth can lead to some spectacular crashes. So let's talk about the hidden risks, because what goes up can definitely come down fast. Let's circle back to Peloton for a second to see exactly how dangerous this can be. After that incredible 434% run-up in 2020, what happened when the stay-at-home theme faded? Well, the stock completely collapsed. It fell 76% and then fell another 77% after that. That, my friends, is extreme volatility. Another huge risk is timing. The legendary investor Peter Lynch had this famous rule. He knew the market was at its peak when he'd go to a party and strangers started giving him stock tips. The lesson here? By the time a theme is so popular that everyone and their cousin is talking about it, the best time to invest might have already passed you by. And then there's a risk that can literally come out of nowhere: regulation. A single decision from a government agency can completely change a company's entire future. Just like that. This is a true story from one of the authors we reviewed. An investor bought into a promising little biotech company. Everything looked great. And then, bam. Step 2. The FDA unexpectedly rejected their new drug. The result? The stock plunged from over $6 a share down to 97 cents, an 84% loss. in one day. So, to recap the big challenges you really have to consider, you're dealing with extreme volatility. Timing the market is incredibly difficult. If you put all your eggs in one theme, you're facing serious concentration risk. And of course, those regulatory curveballs can wipe out your investment overnight. Okay, so we've seen the incredible highs and the pretty devastating lows. This all brings us to the single most important question. Is this strategy actually for you? Does it match your mindset? Ultimately, it really comes down to your personality as an investor. Are you a thematic investor? Someone who genuinely enjoys following trends, doing the research, and is ready to act on new information? Or are you more of a passive investor? Someone who wants to set up a good portfolio that can pretty much run itself so you can focus on your career, your family, your hectic life. Neither one is better than the other. It's just about what's right for you. And that really brings us to the end. The whole point of thematic investing is to look ahead, to try and see what's coming around the corner. So I'll leave you with this one question to think about. As you look at the world today, what's the next big theme you see on the horizon? All right, welcome back. So look, if you're watching this, I'm gonna guess you've already got the basics down. You know, the boring part of investing, the part that's actually super effective, right? Setting up your long-term plan, putting it on autopilot, and just building wealth the smart way. And hey, congrats on that, seriously. But let's be honest, maybe you've got a little bit of an itch to scratch. You're looking for something a bit more active, something that's, well, a little more fun, and that's exactly what we're going to get into today. We're diving headfirst into the exciting, but yeah, much riskier world of trading, and our main tool for the job? Options. Okay, so first things first. We have to draw a really clear line in the sand here. There is a huge difference between being a long-term investor and a short-term trader. It's not just about what you buy, it's really all about your mindset and your timeline. And yeah, this slide just lays it out perfectly. Investing, that's the marathon. It's all about accumulating wealth over years, maybe even decades. You're probably using those passive, set it and forget it strategies. But trading? Phew, that's a whole different beast. It's a sprint, it's super active, it's short-term, and you're using tools like options to try and make money on price moves that happen over just days or weeks. Now, before you even think about placing a trade, this is absolutely crucial. You have to wall off your serious money, your retirement funds, your long-term goals. That's sacred. The author we're drawing from here, he keeps his trading account to just 1.5% to 2.5% of his entire portfolio. This is his fun money, totally separate from the real wealth-building machine. All right, so let's talk about the main event, the primary tool in pretty much any trader's toolkit, options. Now, I know they can seem super complex and there's a lot of jargon, but the core idea, it's actually pretty simple when you break it down. Okay, so what is an option? At its heart, it's just a contract. That's it. It gives you the right, but not the obligation, and that's key, to control 100 shares of a stock for a specific amount of time at a specific price. You get all that control without having to fork over the cash to buy the shares outright. And for that privilege, you pay a small fee, which is called the premium. Okay, take a look at this. What I love about this is how it cuts through all the noise and just boils it down to these 4 basic boxes. You've really only got 2 types of options, calls and puts. And you can do 2 things with them. You can buy them or you can sell them. Which one you choose, well, it depends entirely on one thing, which way you think the stock is going to go. So let's start with being an options buyer. This is the simpler side of things because your risk is totally defined right from the start. Super simple. If you buy a call, you're bullish. You want the price to go up. If you buy a put, you're bearish. You want the price to go down. But here's the best part. In either case, the absolute most you can possibly lose is the cash you paid for that contract. That's it. Your risk is capped. Okay, and this is a huge but. Selling options is a completely different ballgame. Seriously, when you're the seller, you are taking the other side of that bet, and your risk is not limited. In fact, in some situations, your potential losses are, well, theoretically infinite. Let that sink in. This is absolutely not something to mess with unless you know exactly what you're doing. All right, so now that we've got the basic building blocks down, let's look at how traders actually put these things into practice. We're going to walk through a couple of the more common strategies that people use to try and generate a steady stream of income from the market. So this first one is called a cash-secured put. And honestly, the best way to think about it is like this. You're getting paid to make a lowball offer on a stock you already wanted to buy anyway, right? You sell a put option, and somebody pays you cash, a premium, right now. In exchange, you promise to buy 100 shares of that stock if the price drops to your target level. It's a win-win. Either you just keep the cash for free, or you get to buy a stock you love at a discount. Now, that whole idea, the cash-secured put, is actually the engine that drives a really popular income strategy. You may have heard of it. It's called the wheel. And as you can see from this diagram, it's designed to be a continuous cycle, constantly spinning off cash premiums at pretty much every step of the way. And this just lays out the whole process perfectly. Step 1. You sell those puts to collect premiums. If the stock price drops and you get assigned the shares, no problem. You just move to the next step. You turn right around and start selling call options against those shares, collecting even more premium. And if the stock rises and your shares get called away, well, you just go right back to the beginning and start the wheel all over again. But here's the thing. Making money on paper, looking at these neat diagrams, that's one thing. Navigating the actual emotional reality of trading when real money is on the line, that is something else entirely. The calm, cool logic of a strategy like the wheel can just evaporate when a trade goes sideways. And that brings us to a very, very personal story from our source. Yeah, that's literally how he starts the story. And it is just a chilling reminder of how fast a tiny, supposedly safe trade can spiral completely out of control and turn into a weekend of absolute gut-wrenching stress. So here's how it started. It was supposed to be a safe trade. He was using a strategy called an iron condor. Don't worry about the name. It's basically just a bet that a stock will stay nice and calm within a specific price range. And his goal was so small, it was almost funny. He was just trying to make $45, $45, on a trade that had an 85% statistical probability of working out. I mean, what could possibly go wrong, right? Well, it turns out the market does not care about your probabilities. A couple pieces of bad news hit, the market started to tumble, and all of a sudden that safe bet was deep in the red. Instead of making $45, he was now staring down a $300 loss. So he did the smart thing. He decided to cut his losses and just get out of the trade. But, and this is where it gets bad, a simple mistake, a misclick when he was placing his order to close the trade, meant it didn't actually close. He woke up on Saturday morning, checked his account, and discovered something horrifying. He had accidentally been assigned a position that meant he was now shorting the market to the tune of $65,000. He was basically making a massive, leveraged bet that the market would crash over the weekend, a position he never, ever, ever wanted to be in. So after what I can only imagine were 2 sleepless nights, Monday morning finally came. He logged into his account, just bracing himself to see the financial damage. And then, by an absolute stroke of pure dumb luck, the market opened and immediately started to fall. His terrifying accidental short position ended up making him a profit, over $2,000. But this is the most important part of the whole story. That lucky profit, it meant nothing to him. The $2,000 was not worth the gut-wrenching stress and the pure fear of that weekend. It just completely overshadowed any financial gain. And what a powerful lesson that is. The emotional cost of trading can be so much higher than any dollar amount. So, okay, we've covered the mechanics, we've looked at a few strategies, and we've heard a pretty intense story from the front lines. So what does all this mean for you? Where do you go from here as you think about your own financial journey? You know, in the end, it really just boils down to this one question. Trading can be a really engaging, maybe even profitable hobby, but it comes with very real risk and, as we've seen, some pretty significant emotional stress. So really understanding both sides of that coin, the potential for fun and the potential for genuine fear, that's the first and maybe the most important trade you will ever make.
Today, we're going to talk about a single document that could literally change the way you invest forever. It's a tool that's all about taking emotion out of the picture and replacing it with a clear, personal roadmap. It's called your Personal Investing Constitution.
But first, let's start with a feeling I bet we've all had. That pit in your stomach when you look at the news and the market is just a sea of red. Your phone is buzzing with alerts. What do you do in that moment?
It's a simple question, but really, be honest with yourself. When things get chaotic, is your first instinct to just sell everything? Or maybe you see a stock taking off and you get that FOMO, that fear of missing out, and you just have to jump in. If any of that sounds familiar, trust me, you're not alone.
And that's the real problem, isn't it?
Without a plan, you just get tossed around by the waves of market panic and hype. You end up making these knee-jerk decisions based on fear or greed instead of a real long-term strategy. You're just adrift with no idea where you're heading.
So how do you stay on course when the storm inevitably hits? Well, you need an anchor, something solid that's designed to hold you steady and keep your eyes on the prize no matter how choppy the water gets.
And that anchor is your personal investing constitution. You can think of it like a company's founding charter or a legal document for a trust. It's the rulebook for your financial future. It's a set of rules that you write for yourself when you're calm and rational, so you have something to lean on when you're feeling emotional and panicked.
And that's the key right there. This isn't some document you write once and then shove in a drawer. It is your anchor. So when you feel that pull to do something impulsive because of all the short-term market noise, you come back to this. It reminds you of your plan, your goals, and why you started in the first place.
Okay, so what actually goes into one of these things? It's probably a lot simpler than you think. Let's break down the essential pieces.
All right, it all starts with your goal. You know, the what. But honestly, what's even more important is the why. That deep, personal motivation that's going to keep you going. Then you figure out your time horizon, which is just how long you have to invest. Next is your asset allocation, your mix of growth versus more defensive stuff. And finally, your actual investment strategy. That's it. Those 5 things are the core of the whole shebang.
Now, theory is one thing, but let's see how this actually works for real people. We're going to look at 3 totally different investors, and each one has their own unique constitution built for their own personal goals.
First up, let's meet Rebecca. She's 28, and her main goal is to build wealth outside of her normal retirement account, giving her the option to maybe, just maybe, stop working before she hits that traditional retirement age.
And just listen to Rebecca's why. It's so powerful. She watched her parents spend everything they ever earned, and she's just determined to create a totally different financial story for her family. Now that is a motivation that's going to hold up no matter what the market does.
So here's how that powerful why turns into a concrete plan. She's got a 20-year time horizon, which lets her be pretty aggressive, 80% in growth assets. She's using an investment platform she manages herself with a strategy that's mostly in diversified ETFs and just a small slice for picking individual shares. See? It's all laid out, super clear and simple.
Next up, let's meet Jake and Sarah. They're a little older, and their focus is completely different. They want to max out their retirement savings so they can finally travel the world once they hit 60.
And their why's all about their past. For years, everything was about the kids. Their own dreams got put on the back burner. So now, with the kids grown up, their financial plan is all about making those travel dreams finally happen.
So their plan is built right into their superannuation, or retirement accounts. And check this out. They have different asset allocations. Jake's a bit more conservative with 70% in growth, but Sarah, who's younger, is at 90%. It just goes to show you can even customize your plan within a shared goal. Their strategy is beautiful in its simplicity. Just let their employer contributions do the work automatically.
And for our last example, let's meet Mel. She's 27, and her investment goal, well, it isn't even for her. It's this beautiful, long-term gift she's building for her 4-year-old niece, Lily.
Mel's why is all about leaving a legacy and making a real impact. She just decided that instead of buying a bunch of toys that'll be forgotten, she wants to give a gift that actually grows, a real financial head start in life. It's just an incredibly generous thing to do.
And her plan totally reflects that long-term hands-off goal. She's got an 18-year time horizon, which means she can go for 90% growth. She's using something called an investment bond in her name, with Lily as the beneficiary, and she just makes simple monthly contributions into one high-growth fund. It's the ultimate set-it-and-forget-it plan.
So look at this. It's one tool, the personal investing constitution, but it's created 3 completely different, deeply personal paths. You've got Rebecca, actively building her wealth, Jake and Sarah, prepping for a dream retirement, and Mel, creating a future gift for someone she loves. The framework is exactly the same, but the outcome is perfectly tailored to each person's unique why.
And that, of course, brings us back to you. Now that you've seen how this works for other people, it's time to start thinking about what it could look like for you. What's the deep motivation that's going to drive your financial journey?
And to help you get started, you can actually download the exact template we've been talking about. Just scan the QR code right here on your screen. It's a super simple printable PDF that'll walk you through figuring out your own goal, your own why, and your own strategy.
So,
I'll leave you with this one final thought. Before you even think about picking a stock or a fund, before you worry about what the market's going to do next week, just take a quiet moment and answer this one simple question. Because once you truly know your why, figuring out the how becomes so much easier.
All right, let's talk about investing. Today, we're going to lay out a super clear pathway, a roadmap, really. We'll cover how to start, how to really get serious about it, and, how to build wealth with confidence, just one simple step at a time. Ready? Let's dive in.
For a lot of people, investing feels like a giant, confusing maze, right? Like, where do you even begin? It can get so overwhelming that it's just easier to do nothing. But what if I told you it doesn't have to be a maze? What if it was actually a pretty straight path forward?
Well, check this out. This simple flowchart right here, that's our map for this whole explainer. Think of it as your quick start guide, a totally clear pathway that tells you exactly what to do, and just as important, in what order. We're going to walk through this whole thing together, step by step.
So you probably think the first step to investing is, picking some hot stocks. But here's the thing. According to this pathway, that's not where you start. Not even close. The real first step is getting your foundation rock solid.
And this foundation, it's really built on 3 key pillars. Number 1, getting your current finances in order. Number 2, figuring out your why, your motivation. And number 3, building a super solid mindset. Let's break each of those down.
Okay, so before you put a single dollar into an investment, the absolute first thing you've got to do is get your financial house in order. We're talking about tackling that nasty high-interest debt, like credit cards, and making sure you have a solid emergency fund. It's like this. You wouldn't build a house on a shaky foundation, right? Well, the exact same principle applies to your investments.
All right, next up, we hit that first big box on our map. You've got to know your why. And I can't stress this enough. This is absolutely crucial. Why are you even doing this? Is it for retirement way down the road? A down payment on a house? Maybe something else entirely? Because your answer to that question is going to shape every single decision you make from this point on.
And that brings us to that third pillar, your mindset. You really need to have a rock-solid conviction about what you're doing and why. That way, when you hear about the next big thing or see everyone panicking on the news, you won't get thrown off course. A strong mindset is what lets you stick to the plan that you built for your goals.
Okay, so once you've got that foundation in place, we can move on to the next part of our pathway. This is where things get interesting, because we're shifting from the why to the how. How are we actually going to do this? This part is all about making some really important decisions for your personal plan. First, you'll set your overall strategy. Then you'll pick the right kind of account for you, like an IRA or a regular brokerage account for tax reasons and stuff. And then finally, you get to the fun part, building your actual portfolio.
Now, for a lot of people, the core of a good portfolio is something called a broad-based index fund. The beauty of these things is how simple and effective they are. Instead of trying to be a genius and pick the one winning stock, you're basically buying a tiny slice of the entire market. It's just a fantastic, super low-cost way to get diversified instantly.
So you might be wondering, how does that stack up against trying to pick individual stocks? Well, as you can see here, index funds are just way simpler and generally lower risk. Picking stocks, on the other hand, that takes a ton of research, a bigger appetite for risk, and you've got to know how to figure out what a company is really worth. Of course, the source does mention that for some people, a mix of both might be the way to go.
And hey, if you do decide to dip your toes into individual stocks or other riskier stuff, it's absolutely essential to set up what the source calls guardrails. Think of them like the bumpers on a bowling lane. They're firm, personal rules you set for yourself to limit your risk and make sure the more speculative bets don't end up taking over your whole portfolio.
So what does a guardrail actually look like? Well, a really common one is to just make a rule for yourself. I will never have more than, say, 10% of my entire portfolio in individual stocks. Simple as that.
All right, now for the action. You've laid the groundwork, you've designed your plan. This next part of the journey is all about putting it to work. It's about execution and, more importantly, building the habits that are going to make you successful for the long haul.
If you look back at our map, you'll notice something cool about this part. It's a loop. This isn't a one-and-done kind of deal. It's an ongoing cycle, made up of 2 key steps that you just repeat over and over again, adding money and maintaining your portfolio.
So let's talk about those 2 core habits. The first is obvious. You got to keep shoveling money into your investments. The second is performing regular maintenance. A big part of that is something called rebalancing. All that means is every so often, you adjust things to get back to your original game plan. It kind of forces you to sell a little bit of what's gone up and buy a little more of what's gone down. It's basically a disciplined, automatic way to buy low and sell high, and that, right there, is the real engine of building wealth.
Okay, we've made it to the final step on our pathway, and what's so interesting about this last part is that it has nothing to do with more charts or numbers or analysis. It's all about remembering what the point of all this was in the first place.
That's right. The final box on the map literally says, get on with your life. See, a good investment plan isn't your life's work. It's a tool. It's meant to just hum along quietly in the background, building your wealth so you can go focus your time and your energy on the things that actually matter to you.
And as you let that plan do its thing, just remember, this is a marathon, not a sprint. Real success in investing isn't about getting rich overnight. It's about patience and just sticking with it. Time and your solid strategy are your two best friends on this journey.
So, what's the single biggest takeaway from all of this? It's really simple. The best time to start is right now. Don't wait around for the perfect moment, because it'll never come. The key is just to get started. You don't have to go big, just start with small, manageable steps.
And hey, if you need a little extra motivation, think about this. It's really powerful. Because of the magic of compounding, every single dollar you invest today could easily become $5 or even more for the future version of you. That's the power you're tapping into.
So there you have it. The pathway is clear. It's not a maze anymore. You've got the map, all the way from getting your finances in order to, well, getting on with your life. So the only real question left is, what's the very first step you're going to take on that path today?